The one sector Wall Street won't shut up about right now isn't a stock. It's not even really an industry. It's electricity. And the reason should scare you a little, because the smartest people in finance have quietly figured out that the thing limiting the entire AI revolution isn't chips anymore. It's power. Actual, physical, kilowatt hours flowing through a wire electricity. And there isn't enough of it. Here's the number that started this whole shift in thinking. A single large AI data center can now consume as much electricity as a mid-sized city. Not a neighborhood, a city. And tech companies aren't building one of these facilities. They're building dozens, all at once, all competing for the same slice of a power grid that was designed decades ago for a world that didn't have artificial intelligence eating gigawatts around the clock. That mismatch between demand and supply is why, over the past year, you've seen hedge funds and pension funds quietly rotate billions of dollars out of traditional tech darlings and into something that sounds almost boring by comparison. Utility companies, nuclear operators, and the businesses that build turbines and transformers. Let's back up and explain why this is happening, because the mechanism matters more than the headline. For 20 years, U.S. electricity demand was basically flat. Efficient appliances, LED lighting, and slowing population growth in a lot of regions meant the grid wasn't under much pressure to expand. Power companies planned conservatively. They didn't build excess capacity because there was no reason to. Then generative AI arrived, and within a span of a couple of years, the largest tech companies on Earth committed to building computing infrastructure at a scale the power industry had never planned for. Training and running these AI models requires enormous, sustained electrical loads, running 24 hours a day, 7 days a week, with none of the natural variability that made older grid planning workable. So suddenly, utilities that used to forecast growth in fractions of a percent are now fielding requests for power increases of 10, 20, sometimes over 50% in a single region. That's not a gradual adjustment. That's an emergency. And the emergency created a bottleneck because you cannot build a new power plant or a new high-voltage transmission line in the time it takes to build a data center. A data center can be built in under 2 years. A new nuclear plant, historically, can take the better part of a decade. Even natural gas turbines, usually one of the faster options, now have order backlogs stretching years out because every utility and every tech company is trying to buy the same equipment at the same time. This is why you're seeing something that would have sounded absurd 5 years ago. The biggest tech companies in the world signing deals to personally fund the restart of shuttered nuclear power plants. Microsoft struck an agreement to bring a nuclear reactor at 3 Mile Island back online, dedicating its output entirely to powering AI data centers. Other tech giants have signed similar long-term contracts with nuclear operators, essentially agreeing to pay whatever it costs to guarantee themselves a stable, carbon-free, always-on power source. That's not a green energy PR stunt. That's a survival strategy. Whoever locks down reliable power first gets to keep building AI infrastructure. Whoever doesn't gets stuck waiting in line. And this is exactly why Wall Street pivoted so hard toward the power sector. Analysts realized that the actual bottleneck on AI's growth wasn't going to be NVIDIA's ability to produce chips. It was going to be whether there was enough electricity to plug those chips in. Utility stocks that had been treated as sleepy, dividend-paying, low-growth investments for decades suddenly got re-rated as AI infrastructure plays. Companies that own nuclear plants, that build power transmission equipment, that manufacture the specialized transformers needed to step electricity up and down for the grid. These became some of the best-performing stocks in the market, in some cases outperforming the AI chip companies themselves. Now here's the part that connects this to something bigger than quarterly earnings. This isn't just a corporate story. It's a geopolitical one. Countries are now competing over energy capacity the same way they used to compete over oil reserves or manufacturing capacity. Why? Because a nation's ability to build and run advanced AI systems is increasingly viewed as tied to national power, economically and militarily. If your country can't generate enough electricity to run massive AI training clusters, you fall behind in a technology race that governments now consider strategically essential, on par with semiconductors. China has been building out power generation, including nuclear and coal, at a pace that dwarfs most of the rest of the world, specifically because its leadership understands that computing power is now downstream of electrical power. The United States, by contrast, has a slower, more fragmented regulatory process for building new power plants and transmission lines, which is part of why you're seeing so much political pressure right now to fast-track permitting for nuclear projects, and why both political parties, despite disagreeing on almost everything else related to energy, have shown unusual alignment on speeding up nuclear approval. This is also why small modular reactors, compact nuclear reactors, that can theoretically be built faster and sited closer to where the power is actually needed, like next to a data center, have gone from a niche engineering concept to one of the most talked about categories in energy investing. Several companies working on this technology have seen their valuations swing wildly as investors try to figure out which ones will actually get regulatory approval and deliver working reactors, versus which ones are years away from producing anything. It's genuinely uncertain who wins that race, and that uncertainty is part of why the sector is so volatile. For every real breakthrough, there are also companies riding hype without a working product yet. So where does this actually go from here? A few things are worth watching closely. First, watch the interconnection queues, the waiting lists that new power plants have to get through before they're allowed to connect to the grid. In many U.S. regions, these queues are now years long, and that delay is becoming one of the single biggest constraints on how fast AI infrastructure can actually be built, regardless of how much capital tech companies are willing to spend. Second, watch natural gas. Even though nuclear gets most of the attention because it's emissions-free and can run continuously, natural gas turbines remain the fastest realistic way to add large amounts of power in the near term. And the order backlogs for those turbines are a genuine leading indicator of how tight this market has become. When you see turbine manufacturers extending their delivery timelines even further, that tells you the crunch is intensifying, not easing. Third, keep an eye on which regions are winning the data center location war. Places with cheap, abundant power and cooperative regulators, parts of the Southeast and Midwest in the U.S., for example, are seeing enormous new investments specifically because they can offer power access that coastal, high-demand regions increasingly cannot. And fourth, pay attention to household electricity bills, because this is where the story stops being abstract. In several regions where data centers have clustered, residential electricity prices have started climbing, in part because utilities are having to build new infrastructure to serve these massive new industrial customers, and those costs get spread across the customer base. That's turning what started as a Wall Street investment story into a political and social one, because ordinary consumers are starting to ask why their power bills are rising to subsidize computing infrastructure they don't directly benefit from. Expect this tension, cheap AI growth versus expensive electricity for regular people, to become one of the defining energy policy fights of the next several years. What ties all of this together is a simple realization that Wall Street arrived at faster than most of the public did. In the age of artificial intelligence, electricity isn't a background utility anymore. It's the raw material. Chips get all the attention because they're the visible, glamorous part of the AI story, but chips are useless without power flowing into them non-stop. That's why the smartest capital in the world has quietly moved from chasing the flashiest AI software company to buying stakes in the unglamorous companies that keep the lights on. Because in this race, the winner isn't necessarily whoever builds the smartest model. It might just be whoever can plug it in first. If you want to actually understand where the money is moving before it becomes obvious to everyone else, that's exactly the kind of story this channel exists to break down. Not the hype, but the mechanism underneath it. Subscribe if you want to keep seeing where the real bottlenecks in this AI build-out are forming, because power is only the first one, and it won't be the last.